What's up, guys? It's Nathan here. Today, we delve into the latest developments in the mortgage market as National Australia Bank takes another bold step. We'll also examine Victoria's ambitious $8.6 billion pandemic debt levy and its impact on investors, homeowners, and the property market at large. Let's start off the top. Looking at NAB. It's further retracted from the fierce competition in the mortgage market recently. Today, they increased their variable rate for new home loan customers by 0.1 of a percentage point, marking the third time in the last quarter that they've done this. This is also on top of the regular rate increases as a result of the Reserve Bank rate movements. It follows that NAB has recently terminated its mortgage cashback offers, which was previously $2,000, which duplicates a similar move that Commonwealth Bank has made. This shift rises from apprehensions among analysts who believe that the bank's robust pricing and bountiful incentives are leading to new home loans being secured below the cost of capital. And if you find value in this video, please consider hitting that subscribe button as it really helps out the channel. And a big thank you to all our subscribers for your support, inspires us to create more content we hope you enjoy. NAB has previously advised that it plans to terminate its cashback for refinances, which was previously $2,000 and is ending in June. Whilst they've advised this, they've simultaneously started to look at increasing rates for new lending customers only, with the bank increasing the rate for front book clients and the impending abolishment of cashbacks. This is manifesting their intent to deviate from irrational pricing, which is flooding the mortgage market. This decision reflects NAB's strategy, which is to prioritize profits over expanding volumes. NAB's new base variable rate for a simple loan with no offset account has now surged to 5.99% for owner-occupier loans paying principal and interest. This increase will apply to borrowers lending between 60 and 80% of their property value, where there's been no change for loans above 80%. Since March, the bank has risen its front book rates by a further 0.25 percentage point, more than the cash rate that the Reserve Bank has increased by. This independent repricing strategy also mimics that of Commonwealth Bank, which has also elevated its rate for new borrowers by an additional 0.1% that we saw this month as well, which surpasses the Reserve Bank's rate increase of 0.25 percentage point for this month alone. Some regional lenders like Suncorp has also started to decelerate their competitive efforts. It also increased its front book rates by a further 0.13 of a percentage point, more than the Reserve Bank's rate rise this month. Both NAB and Commonwealth Bank are looking to reduce the level of discounts they're offering to new clients. On the other side, we're seeing Westpac and ANZ continue to prioritize volume growth in a battle for market share, maintaining aggressive discounts on new standard variable rates as well as cashback. Westpac offering $3,500 for refinances at the moment, whilst ANZ offers up to $4,000 for a refinance and $3,000 for new home loans taken for first home buyers. Changes have also been implemented this week by Westpac on their serviceability assessment on certain refinance applications that are being examined by the bank in response to growing concerns around mortgage prisons. This is a response to the large number of borrowers in mortgage prisons that aren't able to meet the bank's serviceability assessment of 3% buffer that's required for new loans on top of the current rate that's being offered. Starting this week, Westpac will reduce their serviceability assessment on some refinance applications for borrowers with a solid track record and a credit score of over 650. These reductions will be for loans with lower monthly repayments than their existing ones. ANZ is similarly providing borrowers with sound repayment histories the opportunity to refinance their home loans with less paperwork. As part of the Victorian government's planned $8.6 billion debt levy for the pandemic, which is spanning over the next 4 years, investors, holiday owners, and commercial property owners will bear a substantial part of the financial load. Close to the $5 billion of the debt is slated to be covered by these parties, primarily facilitated by decreasing the tax-free thresholds, increasing rates and additional fixed payments on their land tax evaluation. The State Treasurer announced in the budget on Tuesday that Victoria aims to raise an additional $1.15 billion in the coming year alone. This increase will be achieved by lowering the land tax-free threshold from $300,000 to $50,000 and imposing temporary fixed charges of $500 on properties valued up to $100,000 and $975 for properties up to the value of $300. Owners of land holdings valued up to $300,000 and properties owned by trusts over $250,000 will experience an annual land tax increase of $750 plus an additional 0.1% of the land's value beyond $300,000. The state's decision to abolish stamp duty on commercial and industrial properties will partly balance these heightened land tax demands for some property owners. The government anticipates a substantial yield of about $4.74 billion in the fiscal year to 2024 and over the subsequent 3 years. This increase in revenue will affect investors and multiple property owners, particularly those already facing heightened costs due to recent land value boosts. The Treasurer justified these increased taxes by highlighting the significant 84% in land value growth over the past decade and a steep 25% rise in rent prices in Melbourne and regional Victoria over the past year. The Treasurer defends the changes and stated that the price hikes are a result of supply and demand dynamics, which consequently benefits landlords significantly. He mentioned that Victorians owning multiple properties should contribute modestly to the pandemic debt payment. Certain properties continue to be exempt from land tax payments, including principal place of residence, farmland, retirement homes, and land owned by charities or religious organizations. The Treasurer also announced a transition from lump sum stamp duty payments on commercial property transactions from the middle of this year. This change will liberate businesses from fixed locations, allowing them to expand without having to be burdened by heavy stamp duty costs. Purchasers of commercial or industrial land after the 1st of July 2024 will have the choice of paying stamp duty as an upfront in a lump sum or making a fixed annual payment over the span of 10 years. This can be done through the government facilitated loan, which includes the stamp duty plus interest, and if the owner chooses a fixed payment, no further stamp duty will be payable if they sell the property within a 10-year period. However, if the owner decides to sell, they will be obliged to settle their outstanding payments. After the initial 10-year period, a flat 1% annual property tax based on the property unimproved land value will be implemented. And remember to like, share, and subscribe to stay informed with all things property and finance. The budget paper forecasts a decline in housing property values across the state by about 3.5% this year, but these have been tempered by low supply and limited distressed selling. While the tight credit conditions are anticipated to remain a key factor in the short term, the budget predicts a rise of 6% in prices in 2024 calendar year, supported by elevated migration and strong labour markets. Transaction volumes are projected to start to recover toward the end of 2023, growing a steady 15.3% over 2024 and eventually stabilizing. Did you know here at Hunter Galloway we get mortgages approved? So if you're looking for a great mortgage broker, we can help. Hit us up at huntergalloway.com.au or call us directly on 1300 088 065 and we'll see you next time.